Have you ever stared at a financial chart and just seen, a total mess? A chaotic, unpredictable scribble? It's a pretty common feeling. But what if I told you there's a language hidden in all those peaks and valleys? Well, today, we're going to decode that language. We're going to start with the very engine that drives every single price move you see.
Right, so to most people, this just looks like random noise. But really, embedded in there is a story. It's a story of conflict, of millions of decisions being made every single second. The big question is, can we actually learn to read it? Is there some logic under all these squiggles? The answer, and this is the cool part, is a definite yes. So, to start reading the market, we have to go right down to the most fundamental level. I like to call it the engine room. We need to get what actually makes the price tick up or tick down. And it all comes down to one single concept: order flow. Okay, so here's the most important thing to get your head around. Price doesn't just move on its own. It's not based on feelings or some abstract news story. Price only moves when all the available orders at a specific price level are completely eaten up. Think of it like a constant mechanical tug-of-war between buyers and sellers. It's pretty simple, really. On one side, you've got the buyers. They place what are called bids to buy something. That's the highest price they're willing to pay. And on the other side, you've got the sellers placing offers or asks. That's the lowest price they're willing to sell for. And that little gap between them, that's what we call the spread. Let's walk through how this actually works. Imagine there are a bunch of sell orders sitting at $10. Now, for the price to get to $11, buyers have to come in with so much force that they buy up every single one of the sell orders at 10. Once those are all gone, the market literally has no choice but to tick up to the next price where sellers are waiting. That is the only way price can ever go up. And there you have it. That's the whole engine. Whether it's a tiny little tick or a massive rally that makes the news, this process of consuming orders is what's underneath it all. It's like the physics of the market. Everything else we're going to talk about is built on this one simple but really powerful idea. Okay, so if order flow is how the price moves, the next logical question is, where do the big, important moves actually start? And this brings us to these key locations that professional traders are watching like hawks: supply and demand zones. So what's a demand zone? Well, it's an area on the chart where in the past, the price just exploded upwards. The whole idea is that this crazy move was caused by a huge pile of buy orders from the big institutions. And there are probably still some of those unfulfilled buy orders just waiting in that same spot. And the keyword there is real orders. We're not talking about you or me buying a few shares. These zones are believed to be the places where the big institutions, the players with enough cash to actually move the market, are placing their giant orders. A really simple way to think about it is like this. These zones are like footprints in the sand. A small retail trader, they don't leave much of a mark. But when a massive financial institution steps into the market, they leave a deep, obvious footprint. We can actually see these footprints on the chart, and we call them supply and demand zones. And of course, on the flip side, we have supply zones. It's the exact opposite. It's an area where the price previously took a nosedive. This tells us it's a place where sellers just completely overwhelm the buyers, and it's very likely a big chunk of sell orders are still sitting right there. Okay, so let's recap. We have the engine, that's order flow, and we have the key locations. Those are the supply and demand zones. Now let's put them together and start reading the actual story that the market is telling us through its patterns. The most basic story in any market is a trend. An uptrend, for instance, isn't just the prices going up. No, it has a very specific structure, a series of higher highs and higher lows. This pattern is the visual proof that buyers are consistently in control. So, how does this story even begin? Well, a lot of the time it starts at a demand zone. A ton of buy orders get filled, which creates this imbalance that just shoots the price up, and it breaks past the previous peak to create what we call a higher high. But here's the thing, no market moves in a perfectly straight line, right? After that first big rally, some people take profits and the price pulls back a bit. But, and this is the crucial part, it doesn't fall all the way back to where it started. New buyers jump in above the original low, creating a higher low. This is a massive sign that the buyers are still calling the shots. And then finally, that new wave of buying is strong enough to shove the price right past the last peak, making yet another higher high. When you see this sequence, a higher high, then a higher low, followed by another higher high, you are literally watching an uptrend being born right in front of you. So you see, a trend isn't just some line on a chart. It's a narrative. It's the story of one side of the market, in this case demand, winning the battle against supply over and over again. Every higher low is a failed attack by the sellers, and every higher high is another victory for the buyers.
When you put all this together, it gives you a completely new way of looking at a chart. It's a huge shift from just kind of watching prices wiggle around to actually understanding the mechanics happening behind the scenes. And this really leads to two totally different mindsets. The novice trader, they're often just reacting to what's happening. They see a big rally and they buy because they're afraid of missing out. The institutional approach is the complete opposite. They aren't chasing the price. They are patiently waiting for the price to come back to their pre-planned zones, where they believe the real value is. And this is the fundamental shift. The goal stops being about trying to guess or gamble on what feels like random moves. Instead, it becomes a process of analysis. You're identifying the key zones, you're reading the story of the trend, and you're understanding that constant battle between supply and demand. So to wrap it all up, just remember these three things. First, price only moves when orders are consumed. That is the engine. Second, the big guys leave footprints on the chart as supply and demand zones. And third, trends are the narrative of these forces at work, told through that story of higher highs and higher lows. And that really brings us to the final thought. The next time you pull up a chart, you're not just going to see a random scribble. You'll see the engine, you'll see the footprints, and you'll be able to read the story. So let me ask you, now that you can see these patterns, will you ever look at a market chart the same way again?